Ausbiz. I'm Nadine Blaney. It's a pleasure to be here with you. We've got a special investor event here for you today. The outlook for REITs globally has been on the up, if you haven't been paying attention, really since the beginning of last year. Globally, it's fair to say we were on the cusp of a new cycle with interest rate cuts on the horizon as inflation proved sticky, but ultimately transitory. However, as we have learned very clearly recently, a lot can change quickly. While steeper rate cuts are now being priced in, it is a reflection of global growth concerns, not necessarily good. So where does that leave us as investors? How should we think about the risk versus rewards on offer in commercial property, not just here in Australia, but globally? We'll answer these key questions and many more over the next 45 minutes or so. And we will be answering your questions live, so please do keep them coming in. I know we did get some ahead of this live event right now. And to get us across it all, a very warm welcome to Mark Mazzarella. He is Head of Real Estate Securities at Dexus. Mark, welcome. Thanks.
Thanks for having me, Nadine.
Okay, it's a big question. We will be able to break it down, but what has changed for commercial property in the past couple of weeks? You know, since global markets have really been grappling with the Trump tariff regime.
Well, look, it's been a very, very uncertain period. Clearly a black swan event, but if you're a Trump watcher, it's something that he's been talking about for many, many months, indeed years. I think I heard that he'd been talking about this in the late 80s, so it's really no surprise. But the upshot really is just uncertainty and that, you know, question mark around growth and the fact that it's all coming down to some trade frictions that are going to be imposed, and in a, I guess, macro economy that's incredibly tethered to trade and trade flows, that, as you said, provides a bit of a headwind for growth at a high level.
So we're talking about this throughout this event through, you know, property prism, let's call it that. So what if the US, for example, enters a stagflationary period? Just to put it bluntly, does that kill off the global investment thesis for REITs?
Look, I wouldn't have thought so. Stagflation by design is where there's elevated inflation and low growth. So the commercial asset class, and of course we'll be talking about it through a REIT lens primarily, which is the listed version of that exposure to commercial real estate. It's an asset class that's really dynamic and diverse. There's many different ways that you can get access to inflationary forces in spite of a low growth environment. And one of the sectors where that's the case is in, say, seniors living or seniors healthcare. It's where there's demand-supply imbalance at the fundamental level, and drivers like demographic tailwinds and really a demographic dividend that's going to be paid by an ageing population. That will coincide with a lack of supply in the physical real estate for seniors living. That will drive demand and rental tension irrespective of what's happening in the broader economy. So that's an asset class which we would describe as anti-cyclical and not necessarily leveraged to economic growth or the broader business cycle, that provides investors an ability to get access to growth and total return outcomes that are relatively attractive despite what's happening and despite the risk of stagflation. On the other side, there's obviously sectors that are more exposed to economic and business cycles, and clearly one of those would be anything discretionary, trade related, so also business activity and workforce activity. So, you know, in sequence of those, it would be the traditional retail, industrial and office sectors, for example.
All right, we'll break down your exposure to some of those subsectors in just a bit, but safe to say that now is the time for active management?
Well, look, absolutely. I mean, the last couple of weeks, it honestly stirred up emotions of previous downturns in markets that have been seemingly out of nowhere, and one of those is obviously COVID, which was one of the biggest drawdowns I've seen in my career from markets, and I think that was fundamentally different in the form of a black swan event where no one really had any idea what the implications were, and then we gradually saw that, okay, for real estate and commercial real estate, so much of the valuation thesis is derived from income. And so much of the risk from COVID was income at risk. So scenarios where people weren't using the physical real estate and being allowed to not pay rent for periods of time. And indeed in Australia we had the government directive that tenants didn't have to pay rent and landlords had to eat some of that pain. Unfortunately, this is completely different. We're coming into this point where the operating fundamentals and performance of the physical real estate is actually quite sound across most sectors and selectively incredibly attractive for active managers. And honestly, over the last 2 weeks in particular, we've had probably more investment team conversations that are on the excited side because it's a fertile ground for sharpshooting and finding opportunities, given the market has just thrown up some pretty wild swings.
Pretty wild swings
reactions,
indeed, yeah.
Which is probably putting it mildly. But I think it's a great time for active management. The ability to pick the eyes out of opportunities is really the bread and butter of an active manager and bottom-up stock picker like ourselves, albeit in our narrow sector. So we're really excited and actually, making some active moves as we speak.
Well, interesting, because part of the thesis, and correct me if I'm wrong, you are the expert, about the optimism for global REITs, for opportunities in the sector, was the optimism that improving interest rate environment and cap rates would lead to further investment. But we're told over and over again that in times like this, when there's so much uncertainty that nobody can make a decision, there won't be investment. So does that sort of mute maybe some of the opportunities that will come to offer sort of medium term in the space?
Look, that's an interesting way of looking at it, and no doubt there's absolute merit in that thesis, because clearly when there's uncertainty, there's an element of decision paralysis. You're reticent to make a decision, make a move. Things take longer to play out. But in the listed space, we've got access to opportunities in real time, given those investment opportunities are publicly traded. I think the biggest thing that you alluded to with interest rates coming down, potentially as a driver for REIT returns, is valid. But over the last couple of years, we've had such a big change and volatile, and indeed, a relatively large quantum of move relatively in rates. That direction and magnitude from a low base is what's made it difficult for investors to get certainty in the cost of capital, whereas we've had relative certainty for some time, and the picture for the cost of capital for a number of real estate investors is actually a lot more certain and visible now than it was through other cycles where there were event-driven, market events like the current tariff one that we've got now, and the interest rate inflection of, say, 2022-23. Now it's, we're a lot closer to the certainty in the cost of capital. We have been for some time, and now there's a pathway for that base rate to come down as economies and central banks perhaps realise that they might need to stimulate the economy given the low growth outlook from tariffs. So I think there will be, relatively higher levels of certainty and transaction activity in time, and the interest rate tailwind that with, many commentators and economists much smarter than myself are now forecasting, with Macquarie out for 100 basis points this year and many others bringing forward rate cuts. It just makes the relative picture for real estate returns and the rental profile, which is visible and certain, and the attractive nature of those to be priced by investors is actually quite attractive.
So yeah, let's just flesh out a couple of those points. Cap rates.
Yep.
What's happening right now? What do you anticipate will happen for the remainder of 2025 into 26?
Well, clearly, I think here in Australia, we've seen cap rates moderate and find a trough. So we've had a couple of reporting seasons and indeed updates where the cap rates across many of the asset sectors, with the exception of office, having stabilised. And indeed, there has been some tightening. Office is still in the process of finding a floor, but there have been some transactions in some pretty sizable office buildings here in Sydney in particular, which will give the valuers in the market a bit more of an indication as to where cap rates sit. So we're coming to a point where the cap rate move and impact on valuations will be relatively benign. So the income will be what's driving valuation movements from now on.
And income, sorry to interrupt there, income indicators, if I can call them that, look good as far as demand, as far as rental increases?
Sure. Well, look, it really varies by sector,
Okay.
selectively, of course. Clearly, in a market for, say, non-CBD, non-high quality office assets in Australia, or indeed most markets around the world, there's declining pressure on market rents. So you're not going to get the income support from market rents to drive a valuation. But in the case of a suburban shopping centre, or indeed a prime office building, where you've got leases in place, those leases are indexed to inflation or a fixed amount. So as they go up 3 or 4% and cap rates remain relatively stable, there'll be valuation growth. And that's a broad theme across the globe. Indeed, many of the markets in Europe in particular have actually started to see valuation growth off the back of cap rates stabilising and indeed tightening a little bit.
So we'll delve into real assets in just a moment, but just to push the point a little bit, we've seen a wall of money. There's still a lot of cash on the sidelines, I must say, but we've seen a lot of investment into unlisted assets in general, of which real assets are one. So you don't anticipate that the current uncertainty, the global complexity, yes, it's tariffs, but it's also war in Iran, it's unrest in the Middle East, consumers may be still feeling the pinch from cost of living. You don't anticipate that there's anything to really slow that wall of money that's coming into unlisted assets?
I would say that at the transaction level, I'm sure there'll be an element of uncertainty and pause. But I think in time you'll see that real estate and quality real assets even, will find a pretty strong bid because of those relatively visible earnings outlook fundamentals and I guess building blocks to that. So the relative security of a lease to a really good credit covenant, as well as the inbuilt indexation that goes along with it, plus the prospect for lower rates, will make the attractiveness of a hard asset, a real tangible asset, quite attractive. I think there'll be some activity.
Now, just to put it on the table, you had said earlier this year, I think it was, did my reading, Mark, that 2025 would be the year of REITs. Is that still true?
Look, it's taken a bit of a wobble with the last couple of weeks of tariff moves. Having said that, relative to equities, the REITs have been performing incredibly well. And that's probably coming down to the fact that the REITs provide a relatively defensive and visible cash flow profile from a number of assets and asset types and classes that, irrespective of tariffs, irrespective of what's happening with global conflict, you and I will still be going to the shopping centre on the weekend and struggling to find a car parking space like I was on the weekend. My son will still be in childcare next Monday, and we'll still be coming into the office. And our parcels online will still be delivered by, hopefully the same or the next day through a parcel sorting centre on the periphery of the CBD. And those local assets are essential services and facilitate that. So we're still going to see a fair bit of growth from those. Having said that, there have been obviously share price moves, but that is an excellent opportunity to really pick the eyes out of a market and get set in quality at a discounted price. And we look at implied valuations by share prices, and they've clearly indicated a higher expected return now, because the transaction market, we haven't really seen too much adjust in the immediate term, but the outlook is relatively solid.
Well, you've brought me then. I would like to get Dexus specific. You
Sure.
were talking about, your strategy, your approach. How do you go about understanding the underlying value of an asset? Because you talked about looking bottom up.
Yep.
Do you also look top down? Just flesh it out for us.
We do. Look, in the real estate security space, our process is, probably termed bottom up with a top down overlay. So what does that mean? Look, bottom up, it's really having a look at the individual portfolios and their assets. Bit of background in our team, we've got a couple of career property valuers. So I trained in my early career as a commercial real estate valuer.
Okay.
So valuing the asset, from the bottom up, having a look at a tenancy schedule or having a look at market comparables on a rate per square metre basis is something that you do as a valuer on an asset-specific basis. You also do that for a portfolio through the REIT lens. So that's what I'm talking about when I am asked about bottom-up valuation. So the inputs to that are market rents, obviously where an asset is rented at the current time versus where it could be rented in the future, because market rents are at a certain level relative to that. So bottom up really has a look at that asset specific component of a portfolio. And we can do that across portfolios of REITs. It also forces us to have a look at where the top down intersects with the bottom up. So that is all things like macroeconomic drivers, but also sector drivers. So what's happening in the retail market, for example, are the best shopping centres going to be able to still facilitate consumer demands and provide for a retail offer that retailers want to provide? And that top-down thematic of, say, online retail shift has also been borne out in what's called omni-channel retailing, where the largest fortress malls in the best catchment areas relative to the end population and end consumer are able to do both in-store, physical retail, click and collect, and also fulfill online orders. So that's the top down and the bottom up in a real estate sense. And then of course you have to have a look at the capital structure for these listed portfolios, because they do have debt and we're investing in the equity. So there's a whole host of then equity market and capital market type assessments that need to go into that investment process. But as fundamental real estate specialists, and Dexus is a real asset house, our focus primarily is on the underlying real estate market and valuation outlook from a bottom-up perspective.
I'm glad there's people like you to do that hard work, I guess, on behalf of the rest of us.
I might be doing myself out of a job here, but it's simple at its heart, and it should be for a real asset.
Okay. Well, let's pause. What do you fundamentally define as a real asset?
Look, I think a real asset is one that you can, it derives its value from its physical utilisation, whether that's by you and I sitting in one right now, or whether it's, a solar power asset or a wind farm. Its use derives its income and financial return. It's something you can tangibly look at, see, feel, but its utilisation fundamentally drives its return. And, there's different ways that the ownership structure or contract structure or lease structure for the income stream to an end investor classifies that as real estate or infrastructure, whether it's just a simple property lease, 5-year term, fixed annual rental increases for a retail shop just down on George Street, or whether it's a concession for a public-private partnership operating asset that goes out for 30 years and you get a fixed return if you maintain that asset. In between is really interesting, where Dexus have made a bit of a name for themselves, and the bread and butter, I think, in that real asset space is where they tend to overlap. Some people think that data centres are real estate, others think of it as infrastructure. The asset that I always come back to that's a bit of both is airports, because if you've gone into an airport and had to pay for parking, you've paid a lot of money and the car parking is clearly real estate. You've gone through the turnstiles and you're going to buy some food or, that bag that you forgot to get, which is always interesting at an airport. But they're retail assets and they have a lease in place. But then you've got the terminal, which is down to a longer term agreement or operating agreement with the underlying airline and all the operations that go around with that. So that's the sort of grey area between the two, which is really interesting.
Okay, we will delve and look under the hood of the REIT fund in a bit, but just to set the scene once again, we've got a chart that we can bring up, but it's how you see material catalysts for global real estate going forward. Maybe you could just walk us through what you see still on the horizon. Yeah,
look, interesting. I mean, going back about 12 months, I wrote that there were visible catalysts for the REITs to outperform. And a lot of those indicators have now I think over the last 3 to 4 months probably turned to being enduring catalysts and ones that are material that we can see because they've actually happened. Top-down macro interest rate cuts and inflation coming down. Clearly, at the start of last year, there was a higher level of inflation. We had what many have described as a higher sort of resting heart rate for pricing, and there's been some issues around that, but inflation's gradually come down and is in most of the central bank targeted bands at the moment. And most developed market central banks actually cut through last year, and Australia was the last two, which cut earlier this year. So that catalyst of declining inflation and rates is just one indicator or building block for the REITs to outperform or relative to equities, and indeed absolutely. And then of course from the bottom up, we've got the operating performance, the level of occupancy, the level of releasing spreads, the level of like-for-like growth in net operating income. So that's across a portfolio, what the rent's doing from period to period. Are they able to complete leasing deals to maintain and grow occupancy? Are leases indexing? Are they getting fixed rental growth, but on expiry, are they getting increases in rent? And that's been the case. So you've had that top line growth. You've had the situation where the interest payments and inflationary effects of higher costs at the operating expense level, but also at the interest cost level, because real estate portfolios are geared to, call it 30%. So the interest cost is material. They were all indicating better outlook for bottom line returns. So that's why the outlook was considered to be much better, because there were visible catalysts. And then roll that into the fact that rates have actually come down, inflation's coming down, operating expenses are coming down and stabilising, interest costs probably going to come down a bit better. We're getting into a period where there's been some difficulty in developing the REITs own existing assets. We all know construction costs have gone up. We all know it's harder to get planning approvals. So I'd rather invest in an asset owner and portfolio that's existing, that can take advantage of the market opportunity and benefit when those supply-demand conditions really come to bite. And that varies by sector and market globally, but it's a trend. There's really been no material retail construction for many years. Office construction is elevated, but there will be a pinch point in a few years' time where there just isn't enough space, because a tenant's decision to expand or contract can take place in a short window of time, but it takes years to build a building, and that's across the board. So those ingredients sort of come together, and a confluence of those is that there's great indicators and ingredients for fair value discounts to close. And last year we had a fair value discount, across the globe of, call it 15% odd. It came into around 12 at the start of the year, and with the latest market downdraft, I dare say that'd be closer to 20% fair value discount just on our forecast numbers. And with those catalysts remaining, there might be some difficulty in rental growth. There might be some occupancy issues isolated. But if you have a process to weed those out and selectively allocate capital, over time, definitely as a number of those macro catalysts perhaps become more visible with rate cuts and stimulus and the impact of development really being constrained, we're likely to see those fair value discounts close over the coming years in particular. So that probably indicates that there's better value on offer now than there was 2 or 3 weeks ago.
Great. Well, look, maybe we can look at what is underpinning the global REIT. So give us a sense, a look under the hood of what's in there.
In the fund?
Yeah, in the fund.
Look, it's really a pretty targeted portfolio. We've got a high active share. It would be around 70%. So across a market universe of, call it 400 to 500 individual investment opportunities, we cover probably 200 of those and invest in just over 40. So pretty concentrated. And under the hood of that, look, our biggest exposure from a sector level would probably be seniors living and healthcare, followed by retail, and to a lesser extent technology in the way of data centres, but also living, so residential, multifamily apartments, really defensive, essential real estate. that serves a pretty defensive purpose, and where there's select markets and segments where rental tension is really positive and in favour of a landlord, which, over the last couple of weeks, and I dare say, well, you'll see the performance through this period of time, those REITs that have been able to show a defensive, visible cash flow from an essential type occupancy service or outcome will have held up relatively well. So from an industrial perspective, we've probably got a bit more of exposure to those that are around CBD and metro areas.
Yeah, well, see, industrial has been such a talking point,
Yes.
really since COVID. We know what's happening with distribution centers. We know what's happening on that front. We'll leave data centers for now. It's so interesting because and this is just a personal anecdote, I was driving through California. This is not on the outskirts of a city, but you could just see these on the horizon, massive, distribution centers popping up everywhere. Same with driving down the 401, the biggest highway in North America. It's just, distribution center after distribution center. The only thing I'm thinking in this current environment is it looks as if they're pretty easy to put up. Okay, pretty quick in terms of building, to your earlier point, but also, does the move to sort of onshoring increase the demand or decrease because potentially there would be less flow across borders? Excellent
question. That's really at the heart of probably what's happened over the last 12 months. Industrial REITs peaked around, maybe 12, 18 months ago, and they've gradually underperformed because of that supply issue and the fact that it is easy to put up an industrial shed relatively. There was a lot of capital chasing development opportunities and returns in that sector, and surprise, surprise, the tenant outlook has been incrementally weaker, but you have to be selective and you have to know where the pinch points are. So when you're having a look at the Inland Empire, California, expanses of land, everyone wants to go and service LA and the surrounding areas.
And San Fran and all around there.
There's less rental tension with incremental supply. However, if you have a look at inside the SoCal metropolitan area, where there's smaller boxes that service a number of different tenants, but ultimately serve as that last mile or last touch before it heads to the consumer, that's been relatively more attractive, but still been weak. So industrial is a market by market proposition, and nearshoring and onshoring, that's going to help a certain dynamic to an extent.
Now, I know that you touched upon retail earlier, but we've got consumers under pressure. We've got, I suppose, potentially some pressure being put on retailers, although maybe not anywhere near what we saw in COVID. And obviously, you've been able to rent out, or landlords have been able to rent out some of that space at a premium since then. But it comes down to, you talked about the omni-channel, but with the buildings themselves, it's a way in which we shop, right? Like, these are entertainment centers. Does that still stand destinations rather than just a place that you go to shop?
Yeah, look, at its purest form, what's a shopping centre? It's a place to draw people. The retail offer there changes and is extremely dynamic. And if you're a popular tenant that has a really good retail offer, you want to be in the shopping centres that can draw the most footfall. So what draws footfall? It's not only the shopping destination itself, but it's the ancillary activities and entertainment and leisure type activities that you can do at that centre that drives foot traffic. So whatever draws consumers into an area is where a retailer wants to be. And we would argue that those malls, shopping centres like a Bondi Junction, Westfield, Sydney, would be the ones that ultimately win and are able to drive the most foot traffic, and retailers want to be there. And I mentioned there has been a lack of new retail supply for many years. There's been no end post-COVID, and indeed recently, when you catch up with a number of the retailers themselves that want to get space in those centres, and even service providers that want to get space in those centres and can't.
You had alluded to a mega trend driving the demand and the creation of more seniors living. Is that primarily overseas? Is that part of the global sort of thematic that you tap into?
It's a global phenomenon.
Okay.
Certainly here in Australia as well. We just don't have the real estate securities or REITs that own those portfolios that are investable in Australia. A number of the seniors housing, aged care providers in Australia are privately owned. And of course, overseas though, we've been able to get access to REITs, real estate investment trusts, that own those portfolios in North America, so the US and Canada. The global demographic evolution of an ageing population is a developed world phenomenon, and the best way to play it in the REIT space is in North America, we believe. And we're in this period of time where post-COVID, occupancy was really low. It was really difficult to develop new facilities, and now we've come out of that, and occupancy is absolutely bouncing back, but there's just no supply, and that's an opportunity for rental tension, and not only organic occupancy to come back and earnings to replenish to what they were at pre-COVID, it's also an opportunity for rental growth as well. So there's fundamental bottom-up drivers for that, but also there's a top-down demographic driver that makes that really attractive.
And what about residential? Is there any way that the Dexus Global REIT plays in the residential space? Or again, is that primarily through seniors?
No, absolutely.
Okay.
There's build to rent in the form of apartment developers and apartment owners primarily in the United States. So
and that's much more prevalent there than
it is,
here. Yeah.
Absolutely. Even in Europe and of course up in Japan as well, to lesser extent. So for rent residential is a really developed and scaled investable option over in North America in particular. And you can invest in apartment portfolios that own gateway city exposures, so east and west coast, but you've also got specialists that own portfolios through those smile markets of the Sun Belt, which have obviously been really popular
Like
for
Houston,
renters.
Austin and all that.
Austin, Houston,
Yep.
Florida, have really benefited.
And does that fall under the multifamily sort of
It
category?
does, yes. But there's also single family, which are detached houses. And the other really interesting dynamic driving the prospects for demand and occupancy of those housing portfolios is the affordability from rent relative to owning. So mortgage increases and increased mortgage costs actually made it more expensive to buy houses relative to just renting. So that rent buy equation is in favour of people renting for longer and not buying. So that's been a demand driver for those portfolios as well.
And we're continuing our global tour with you, Mark.
Yep.
Putting it through the paces, but office. So you
Sure.
alluded to the fact that, you know, we've obviously been through quite the period when it comes to office occupancy. What is the state? We'll talk Australia later, but overseas, and are there opportunities there? Because Dexus has really made its name from office here.
Yeah, that's right. I guess on the global space, it really varies by market. You know, it's interesting, I was having a look at some data, and it might be on the chart actually, but there's actually been positive absorption in the Asia Pac. And that's driven by, you know, markets like Singapore and Japan, which have actually had rent occupancy growth and vacancy decline. So there's some really high quality assets and office assets up in Singapore and Japan in particular, and they've been able to be leased. And up in a market like Tokyo, we saw the vacancy rate, say, peak at 6 or 7%. It's now gradually coming down. So that means that there's relatively more space being taken up than vacated, and that's a great, I guess, dynamic for rental growth. However, when you have a look at a market like North America, vacancy rates in office are really high. So we're talking double digits, you know, and in a market like San Francisco, for example, it might be around 19-20% even. And when you have a look at, say, Europe with London, you'll have, you know, the west end of London with a high single digit vacancy rate. You'll have Canary Wharf, which is maybe, you know, double that, but you'll have the London City, which is in between. So the key theme is quality, centrality, and really making sure that you've got the dynamics for rental tension there. A market like Paris, for example, you can't build in the Paris single arrondissements there, so you know it's difficult to redevelop, let alone build a new office asset, and vacancy might be in the low single digits there, and there's rental growth. It really depends.
This is a totally crazy question for me, but do you get to visit all these places, honestly?
Look, I have, yes. That's
Okay,
all
I
part
have
of,
picked the wrong line of work.
That's all part
awesome.
of the bottom-up investigations. I mean, just put it this way, it was 2023, I was in Paris having a look at an office development.
Yeah.
And they were hoping to lease it out the space for, you know, the market rent was about 800 euros a square metre. They were trying to get hoping to get €1,000 a square metre. Announcement a couple of months ago, last month, that they'd rented out the space for 1,100 euros a square metre. I thought the office market was dead, but within the Golden Triangle of Paris, that's indeed not the case. And you know, there's examples of that in every market, because there's some phenomenal buildings, even in the weakest markets, that are going to get that incremental demand and rental tension.
Just to wind up the global sort of conversation for the global Dexus Global REIT, how do global REIT returns compare to equity returns?
Look, it's been a relatively difficult period through the post-COVID era, where the REITs significantly underperformed global equities. I mean, there were periods there where the REITs were up, I think it was last year, perhaps 12 to 14%. Global equities were up 30 to 35. That's clearly non-normal. And we've gone through a normalisation period year to date. The REITs have significantly outperformed global equities. And, you know, like any analyst, we go back and have a look at in what periods and what markets has that dynamic been similar. And the S&P 500 versus the US REIT market is an example, leading into the dot-com bubble bursting, where for 3 consecutive periods, the multiple premium for the S&P 500 versus the REITs or real estate was actually at its biggest discount on the REIT side for 3 consecutive years. That had never happened before. And then just before the dot-com bubble burst is what that indicator was, and the REITs outperformed for a sustained period of time. The last 3 years have been that exact same phenomenon and indicator. And what have we seen so far this year? DeepSeek-induced convulsion in markets, compounded by tariffs. People or investors become a bit more enamoured, focused on what's visible, what's certain, what can you see, feel, touch, know that the rent's coming in, and the REITs are serving their purpose now on a relative sense.
Yeah, well, it reminds me, I didn't ask specifically about data centers. What type of exposure do you have to data centers? Because they're very much the picks and shovels sort of a take on the AI thematic.
Yep, absolutely. And, you know, last year that was very much our thesis. And it has been for 24 months since we started to have a look at ChatGPT. One of our young analysts was pretty enamoured with it about 24 months ago. So the pick and shovel approach is a great one, and that's one that we've leaned into. In terms of our data centre exposure in the global fund, it's probably hovering around the high single digits. We have pared some of it back on relative valuation grounds, but the thesis is unchanged. It's just a question of relative value. We would prefer to own those data centre landlord portfolios that are existing in the market and able to benefit from immediate rental tension and absorption. In a market like the US, quarterly take-up of data centre capacity by megawatts is running at historically high levels. It's probably plateauing to an extent, but nonetheless really high, where on the flip side, not invested to a large degree. We're a significantly active underweight in a name like Goodman in Australia, in the A-REIT space. They're a data centre developer.
Yeah.
So they have a longer gestation period for their data centre thesis to play out in tangible returns. They're going to have to deploy a lot of capital over a substantial period of time amidst some uncertainty, not only market uncertainty, but leasing uncertainty, because they're not yet pre-committed. And we think that's a different or high risk approach to the data centre thematic or exposure.
Does that also stand for NextDC? And I ask the question partly because the jury is still out as to exactly what shape or form data centers will eventually take. Or maybe I should say that the data centre could still evolve as we see technology evolve, and it's happening at such a rapid pace. So does that give you a little bit of caution in that space?
Look, NextDC is an interesting name, not one that we cover or investing in the REIT space. However, over a decade ago, NextDC was the major tenant for a small A-REIT called Asia Pacific Data Centres, which was a handful of assets less than that NextDC were the tenant of. And NextDC actually took that REIT private so they could own and operate the facilities. And that basically says, or that indicates reality, which is these operators, hyperscalers, would rather own and operate their own facilities because the amount of CapEx and the amount of business exposure that's critical to that asset means that they want to have control. So keep that in the back of your mind. But NextDC, as I said, is a name that we don't actively cover.
Yeah. Apart from that, though, you're nimble enough that you can adjust your exposure to A-REITs if the sort of outlook changes.
Oh, absolutely.
Yeah. Now that we're on A-REITs, we asked about global REIT returns. Same question for Australia. What have the returns been like?
Look, they've been, pretty phenomenal coming into the end of last year, where the A-REITs were relatively strong, led by Goodman Group as the major constituent. It was tracking at, over 40% exposure. It had been up, 50 to 60% in 1 year. And that was really driving A-REIT returns. In terms of the A-REIT fund, which we manage, that's been in the market for 16 years, and the total return per annum CAGR over that time has been over 9%. So really solid returns over a long period of time from a fund that invests in, all manner of commercial real estate, alternative real estate, but essential real estate, and most of that return is characterised by income. So rental income, about 2/3 of that, with 1/3 from capital growth. And the asset class has proven over that period of time, and the fund in particular, to really drive and maintain, indeed grow, the purchasing power of investors' capital. So the returns have been pretty good, but of course, volatility is the price we pay for liquidity, and public markets exposure to real estate securities is prone to volatility as a result of being able to be liquidated.
We've just got this up on screen, and I think it is interesting. Oops, we just took it down. We'll get it back up. These are names that many of our viewers, most of our viewers, would be very familiar with. And I think it's really interesting to see Goodman on there because there's been such hype around Goodman, obviously, because of the data centers. And also industrial. I mean, it did really well. Vicinity centers is one that we'd recognize. Stockland. So just talk to us about where you see resi heading here in Australia, and why Stockland perhaps would be the preferred pick.
Yeah, sure. Look, Stockland and Mirvac are often talked about in a bucket of the default residential exposure for the ASX, and indeed in the REIT space. We prefer Stockland at this current time because Stockland is a name that has relatively more exposure to communities, so master plan communities, house and land.
Yep.
Whereas Mirvac has more exposure to not only commercial and CBD office, put that aside, but apartment developments. So the difference between the two is that communities, master plan communities, house and land, offer a relatively affordable residential outcome. That's a great one, because we all know the affordability issues. And two, the profile of capital and development return is a lot less volatile and lumpy than, say, building an apartment complex, waiting to sell that out, and then returning capital once they settle. So the profits are relatively more volatile for, say, an apartment developer like a Mirvac, and prone to market volatility, which at the current time is difficult because we all know it's difficult to build anything. We all know construction costs are increasing, and we all know that the affordability issues are there, and it's hard for that mass market affordable type of apartment to be built anywhere in Sydney and be an option for a first home buyer. Whereas a house and land package is relatively more affordable. Stockland has many other strings to their bow and an excellent management team.
Well, I live in a place where we and the neighbours say we're going to Stocklands when
There
we're
you go.
going to the shops.
Yeah, and some great retail assets.
Yeah, that's what it is. Look, I've been a little bit of a hog, right? Asking all my questions. We do have a few questions I'd like to get to from the audience. Believe it or not, that's been about 45 minutes.
Oh, wow.
Here's a question that's come in from Rick saying, will you increase exposure to data centers in the US or Australia?
Excellent question. Everything has a price. And that's the beauty of the REITs and listed real estate space. Many of them are oversold. Whether that is risk adjusted and relative to other names, that we would take that opportunity if it presented. But for the right data centre portfolios, absolutely we would.
Here's more of a technical question, but what happens to the fund when revaluations happen? What's the process? Do investors even know? Yeah, great question. So listed real estate, traded on the stock exchange, we own shares in those REITs. Our valuation goes up and down daily with the stock price of those REITs. Whereas if you're in an unlisted fund that might own, like the Dexus Wholesale Australia Property Fund, it might own, say, 30 odd individual assets. They get revalued quarterly, and the NAV or unit price of an investor's holding will change quarterly with that valuation. So there's the volatility difference, but liquidity is what you can get with a real estate securities fund. Got it. And this is from Louise. Can you clarify what kind of infrastructure assets the global fund is exposed to, and do you pay distributions? Yes. So last question first. Yeah. The global fund pays a monthly distribution, as does the Australian REIT fund. So all of our funds pay a monthly distribution. Yeah. On the infrastructure side, it's the definition of infrastructure. We invest in REITs, real estate securities. In the US, mobile tower portfolios were able to convert to REITs many years ago. Okay. So we can invest in mobile tower companies. American Tower, Crown Castle are two of those. So that's mobile phone towers and small cell towers to a lesser extent. So that's the infrastructure perhaps overlap that you might see in a global REIT fund versus a global infrastructure fund. Infrastructure in that sense. Infrastructure, in any other sense, like your local, childcare centre, some would argue that's critical social infrastructure. We could absolutely invest in that as well, but we don't invest in anything like, say, a toll road or utilities or renewables.
Company.
I was going to say, yeah.
That's right.
Got it. All right. Look, that I think takes care of those questions, and only for the interest of time. And you'll obviously be able to go online and take a look at the fund in a little bit more detail. But so you're saying that it's not, 3 weeks ago we might have been saying, is it too late to jump on the REIT train? Now we might say, is now a really good time to be jumping on the REIT train? Look, markets are uncertain. There's always going to be, black swan events, pressures. I would have said a month ago, the total return outlook for our fund might have been, on our models, double digits in the low teens, which is 8 to 12% is what you should expect from a listed real asset class like REITs. With the most recent market drawdown, we would say that the fair value upside is probably a bit more than that. There's some opportunities that are really oversold, and that's probably why we're excited about deploying into this market as active managers, relatively more so than we were a couple of weeks ago. So yes, I think the opportunity is an excellent one. Look, Mark, really appreciate you coming today. That was a fascinating conversation. Thank you. Thanks, Nadine. Well, thank you for your questions and for watching. Thanks to our partner Dexus, and of course, Mark Mazzarella for joining us. Just mind the disclaimer, and we hope to be with you soon. We'll get this up online if you'd like to watch again.